Hello, everyone, and welcome to today's webinar. In this session, we're diving into the latest insights from the 3Q 2024 REITs earnings reports and exploring how these results reflect broader trends in the industry. I'm Christine Wachsman, Director of Market Analytics at StorTrack, the leading provider of self-storage data worldwide, and I'll be moderating today's discussion. Joining me are two experts, Andrew Jones, VP of Development at JustStorage, and our very own Jim Breunig from StorTrack's business development team. Andrew, Jim, it's a pleasure to have you both here today. And I'd like to take a moment to allow each of you to give our audience some background on your experience in self-storage.
Yeah, of course. Well, Christine, great to be here. My name's Andrew Jones. I'm the VP, Vice President over at a company called JustStorage. I oversee all the third-party management and ancillary revenue over there. Additionally, I host the JustStorage podcast and the StoreCast podcast. And again, Christine, thank you so much for having me on today.
Hey everyone, I am James Breunig, Jim, with StorTrack. I am a business development manager. I've worked with a lot of different groups, from developers to large scale, small scale, medium operators across the whole spectrum in self-storage. So I get to see a lot of different scenarios. And then also we put out a weekly update, our StorTrack Tuesday tips. So again, check that out on LinkedIn if you get an opportunity. Also, you can subscribe to our email and you'll get updated on those as well for any new developments with StorTrack.
Again, thank you for being here. So let's start with a big picture question. Over on these earnings reports, we're seeing a slight decline in year-over-year revenue, yet occupancy remaining strong. Do you think this signals resilience in the self-storage market, or are we potentially facing a slowdown?
With my experience at Extra Space in the past, one of the key metrics we looked at and that we look at JustStorage are Google Trends, right? How many people are actively searching for self-storage today? And during the pandemic, that was quite high. And you can kind of see it's kind of coming back to the mean of a couple of years ago, pre-COVID. So the resilience is definitely still there. But the highs of COVID, well, we're kind of coming back to reality. So whether you're small, big, or somewhere in the middle.
I would agree with that. Again, too, when it comes back to your marketing, look at where how many inquiries, if you can find that type of information out. I do think we're kind of coming back to more of the norms, and what most people are looking for 2025 is really kind of more of a stabilization. Certain markets do have a tremendous amount of pressure that may weigh out trends such as, where people are migrating, population growth, income growth. There's a number of different factors, but that's why we always tell people look at all of the different data points to really kind of understand that market.
I couldn't agree with you more. Data is paramount in providing those insights that would help you navigate the market dynamics affecting self-storage. And as you both mentioned, marketing seems to be a major focus in this increasingly competitive environment, which actually brings me to the next topic. Across the board, the REITs reported between a 1% to 5% increase in operating expenses, marketing obviously being one of those line items. But the other ones that stood out to me were the non-controllable expenses like property taxes, interest rate costs, and insurance expenses. How do you see operators balancing the challenge of increasing expenses while staying competitive? And you've both been on the operations side of the business, so I'm curious to hear what you think.
That's a great question. I mean, if we go ahead and take a look at any stores that are in Florida, for instance, right, the property insurance premiums went up sometimes upwards of 100%. I had stores in Chicago that went up, 50% because there are now tornadoes that are in Chicago, right? So it's one of those things that you try to hedge on, and you try to see the future of, you take a look at your crystal ball and you say, is this going to increase by 50%? Probably not, but 20% we kind of hedge on that. Having said that, how do we continue to stay competitive? I mean, we keep on doing the same things that we're doing, but we might be looking at an asset in a particular market and we say to ourselves, maybe we're going to go ahead and sell that asset off to somebody else that's more risk tolerant, than us. And let's use that money for a less kind of risky market. And again, we're just kind of horse trading at that point, but that's how we're kind of seeing the future.
I would tend to agree. Again, being a little bit being out of the operations side for a couple of years now, but hearing what our clients are saying is that there are certain areas, obviously, that pose a higher risk. In insurance, again, I think from my understanding is that you used to have a few more options, and that's getting more difficult to negotiate. You've got labor. There's a number of different impacts. Again, a lot of it's dependent upon the area you're in. It is on the rise. Energy costs. There's a tremendous number of factors.
With expenses going up, the immediate reaction is usually we need to increase prices. And we're certainly seeing prices increase, especially in areas that are being hit by tornadoes, as Andrew mentioned. So with that said, do you think that price increase is a sustainable strategy? And how do you think that would affect customer demand and long-term growth?
No, it's definitely sustainable, as we've seen with, Extra Space, Public, NSA, Cube, all the REITs, right? It's that's a core strategy is, increasing rates, right? It could be 5%, it could be 10%. Sometimes I've seen it as high as 60%, which is very aggressive and I don't think should be followed. But the way that we're kind of doing it here at Just Storage is, okay, we need to rethink our technology stack and let's say more Nest thermostats at a facility, being very conscious of, our HVAC spend, for example, or adding more ancillary services to the customer, such as, smart units, better moving services, even above ground fuel tanks we're looking into at our sites, which is kind of a crazy thing to think. But again, as costs go up, your revenue shrinks. So we're kind of getting more creative.
That's interesting that you mentioned some of those items because I can't recall which REIT it was where you could see that they leaned heavily on technology to control those expenses. And I believe that's reflective of what's happening across many facilities where technology is used to streamline operations or enhance their product offerings with features like security cameras or automated access for customers. Ultimately, I believe really is good for the customers as well. So again, focusing on these expenses, one thing we've touched on earlier is something that has increasingly been on everyone's radar: natural disasters. The damage from Hurricane Milton resulted in over $10 million in costs for extra space storage, spotlighting the growing financial impact of severe weather. With these events becoming more frequent, how should self-storage companies adapt? And do you see rising insurance and operational costs as inevitable for properties in high-risk areas like Texas and also California with the wildfires?
Yeah, I'll go ahead and take that one again, just because I had a conversation with a partner the other day about this. It's a very, hey, I found this great property in Miami. I think it would be great for the self-storage facility. And it was kind of a, come to Jesus moment where I said, well, you're really going to have to think about the premiums of insurance and partially, part of your building coming down. So now he's looking more towards Buffalo, New York, because if we look at kind of the climate statistics here in the next 10, 20 years, or however long he wants to hold this asset, it's going to look a lot better. And his NOI is going to look a lot better because of that. So as I kind of talk to any investor or partner or whomever that's really going to spend a chunk of money in a particular market, it's A, you either have to build a much better building structurally and be, cognizant that it might fall down, or B, maybe that market isn't the market you should be getting into, especially if this is your fourth, fifth, or maybe even like your 50th property. So that's my 2 cents there.
And I just had this question asked yesterday. Somebody seriously asked the question, should I build in a flood zone? And excuse me, the flood maps are changing. And again, like even where I'm at, initially I was not in a flood zone, but again, these flood zone maps are changing. So again, staying, in touch with what's going on in all these markets. And as Andrew said, if risk tolerance or the type of structure that you're looking at isn't going to be real adapt to some of these changing weather patterns, it's definitely something to be concerned about and, start thinking about other areas. I think along with that too, I think you're going to see some huge numbers, at least this is what I'm hearing from different people when it comes to migration, where people are locating. That's even impacting where people are going to live. So when you're looking at future growth, staying in touch with where that future growth is forecasted, along with that, I think those two are really key.
with these growth strategies, it's absolutely essential to pay attention to demand levers, like where's population growing, where's urbanization happening. But there's also other factors that actually signal growing demand as well. And Andrew, in our conversation yesterday, you mentioned a few markets that you were directing potential investor towards and away from the big markets like Texas and Florida, the darlings of self-storage. So could you speak more to that?
Yeah, I love the Midwest, right? In particular, shout out to his name's Eric. He owns a couple properties in northern Wisconsin, right? And those markets have been a total anomaly to me, where you have a ton of people moving into northern Wisconsin in smaller cities. They want to be in more kind of a suburban kind of outfit. And it almost seems to me that the price, or excuse me, the demand there is higher than the 10 square foot that you see nationally on average, right? And I
Mhm.
see that even in northern Michigan as well. And these are areas of the country that won't be impacted, and again, this is just more of a risk tolerance thing. Like, hey, if you want to, move up to northern Michigan and build a facility there, good for you. It's going to be less risky. But also I'm starting to see and drive investors to these areas because there's a lot more population growth. And in the long term, especially these individuals that want more generational wealth for their facilities rather than selling it in 5 years, I kind of steer them over more to the northern Midwest.
And Jim, are you hearing this trend as well with clients that are directing their focus more on the Midwest and certain tertiary markets?
Yeah, if you look back like over 2024, I'm not going back years again, coming out of COVID, everything's kind of going through this weird phase where it's kind of getting its legs again. But looking back over like the last 11 months, some of the strongest or the rates that held ground the best have been in the Midwest.
Mhm.
Um, and again, so if you can look in the Southeast, you can look at Texas, you can look, and again, there's always outliers to all these markets, but overall, the Midwest has been the most stable and probably most price resilient in having markets increase. So.
That's interesting you bring up prices because one major trend we're watching closely here at StorTrack is the growing gap between in-store and online rates. 2 years ago, it hovered around 11 to 12%. And a few months ago, we saw it peak at almost 20%. And this is as prices are going down. So, Jim, let's hear your take on this because we've had a lot of conversations about this specific trend.
That is, it really kind of speaks to the strength of the market. So the closer that gap, you're going to see probably fewer promotional specials. You're going to see probably a stronger rate growth potentially versus a decline. So there's a couple of things. The other is it kind of goes to valuation of the property itself. People are really kind of keeping a close eye on those in-store rates. Is those in-store rates tend to start to decline, that's going to affect valuation.
Right.
So again, that's where people are kind of keeping a really close eye on those two. And again, it does speak to the strength of the market. The larger that gap, probably the softer the market.
Are customer behaviors or expectations at play here in on any part of that growing gap?
I think so. Housing obviously plays a huge role in it, where interest rates are at. That can't be understated, and obviously that's kind of beyond the industry control. But when you look at just the sheer need and where that need's going to arise, that's again goes back to the migration,
Right.
goes back to where people are moving. What happens over the next year now? We're going to see what happens with interest rates if the markets get moving. But there's a lot of factors. And again, supply. Certain markets really did get hit heavy with new development, new store openings. Again, whenever you have that, especially if you have like a cluster of new stores that just opened,
Mhm.
it's going to cause some separation in that price gap too, because people are offering specials trying to get leased up.
And speaking of new supply coming into the market, and in general, there's a lot of completions happening over the next 3 quarters. And then thinking about how regional dynamics bring their own unique set of challenges when trying to find that equilibrium with demand, which actually appear to be softening in parts of the US as competition intensifies. And I'm thinking of the Southeast here. Do you attribute that solely to oversupply or other economic factors at play here?
That's a great question. And if I could quote Joe Margolis, the CEO of Extra Space, if we knew the answer to that, I mean, that's the billion-dollar question in self-storage, right? Like, what is the true demand in a 3 mile market anywhere in the US? Like, it's very hard to kind of understand that. I mean, StorTrack, you all do a great job at trying to help me try to at least get an understanding of that. But at the end of the day, it's very hard for me to understand and look at a market and say, oh, this is a 15 square foot market, or this is a 5, square foot market, or a 6 or a 7. I mean, the way that I look at it is more of the macroeconomic factors. How many rental households are there? How many, non-rental households are there? Is there a military base? Is it student housing? That kind of starts to give me an idea on what that demand will truly be. But for me as an operator and a developer, I look at that and I say, oh, well, this is just how I'm going to configure my unit mix, and I'm going to create my pro forma to 90%. And if I get above 90%, awesome, wonderful. Or if I get a little bit below, then maybe I need to do some virtual conversions or whatever you need to do. But in my experience, if you were to ask me, what is the true demand of this area? It's a couple of different factors. And at the end of the day, we're all in real estate. So it's like, it's going to be a risk, but we try to control that risk as much as we can.
Identifying true demand is certainly a challenge, but it seems like those main drivers for self-storage continues to be a reliable signal. Again, population growth and wherever there's clusters of people really who live in those smaller areas. And as urbanization becomes more of a, I don't want to say trend, but it's happening a lot more, especially in other markets like Europe, for example, self-storage becomes a real necessity. And my question to that is something I've actually been wondering for a while. I've been reading and just hearing that the rise of e-commerce has also been a demand driver for the use of self-storage. And that makes me wonder, along with personal use, how much of a self-storage facility on average do you think is attributable to business use? And is that number growing?
I mean, in my experience, 10%. I mean, I think 10% of most facilities across the United States, and again, taking this from Extra Space as well, is devoted to commercial customers. Now, you can go ahead and increase that if you'd like, if you want to increase your marketing spend on that and entice more of those customers. But I think 10% is kind of the number. So you definitely don't want to bank on them. But it depends on kind of your area and your marketing spend. And if you are truly enticing them, that could get upwards of 25 to 50% if you're very savvy about it. But again, we're always still looking towards the, me and you or anybody else in this webinar that's just moving to a new place.
It seems that it's really about keeping your pulse on the industry to figure out how customers are using the space and what their changing needs are. So now let's shift to another challenge, mergers and acquisitions, which come with their own unique risks and rewards. An interesting example I'm thinking of is the merger of two industry giants, Extra Space and Live Storage. Looking at their earnings reports, Extra Space showed a $51 million impairment loss due to the Live Storage trade name. Despite this, they managed to increase their core FFO, which excludes those certain non-recurring items, to me indicating strong underlying operational performance. So from your perspective, what are some valuable lessons here for companies pursuing acquisition?
Oh gosh. Well, I was there during the merger.
Perfect question for you.
Well, it's more of the expectations on the staff of the company, particularly if it's two large companies like Extra Space and Life Storage. I think this, and let's go down to like the district manager level, somebody that oversees 20 stores in one region at Extra Space. They were very confused because you had, let's say, 10 Extra Space stores and then 10 Life Storage stores. And how are we supposed to like mingle these together? Are they the same store? Are they the not store? Or, effectively, even as I'm saying it out loud, it's confusing, right? And that's one of the reasons why Extra Space is moving to have just one brand. No Life Storage, just Extra Space moving forward. So I think the biggest thing that I learned from that merger, especially a large merger like that, is to really prep your staff and to really train them as much as you can, because it seemed like there was not a lot of that when I was working at Extra Space. And that was unfortunate. But again, Extra Space came around and they still did very well with those stores, even though they could have done even better. So
at some point I had read, and I haven't talked to anybody to confirm this, but I believe I had read that Extra Space and the Life stores were being run with a little bit different pricing structure. So one was trying, it's kind of like let's say Honda and Acura, right?
Yeah.
One is going to be your base model, the other one's going to be the higher model. And I heard talk that that was one of the things that potentially could come out of it. I don't know if that ever did materialize or not, but I think when it comes to any of those acquisitions or large mergers or even just from an acquisition standpoint, I think that branding is so critical to the success. So that's why it is kind of having two brands is really kind of it's got to be tough.
Yeah, I can imagine. Jim, I know you have some experience with a brand undergoing acquisition. And to Andrew's point earlier, a big challenge certainly is trying to integrate people using, the different management styles. What do you think is the lesson here for operators to have a more seamless merging process?
That's why actually I worked for a couple of groups that were actually partnered up or consumed, however you want to put it, by NSA. And that was a different approach, I think, than my experience with like a public storage or an extra space. I've been involved with those as well. Um, and it was more of a slower process. And I think it was kind of almost a NSA, especially in the beginning. This I'm going back now to 2017, 2018, where there was this almost a split management process where these brands still manage their facilities for the most part with oversight. So a little bit, it's a different process. Um, and I think that does make a difference. Whereas for an extra space or a public storage, or any of the large REITs for the most part, they're going to come in, rebrand, retrain, and keep this, really uh, keep the project really on its path, right? Whereas NSA was a little bit more of a slower integration.
So, aside from acquisition, growth can take on many forms, and one increasingly popular strategy is using third party management. So, I'd like to dig into that trend. We have public storage, extra space, JustStorage, and other emerging entrants who are starting to offer this service. Do you think third party management is now an essential for smaller operators?
I think it's more, I mean, this is where third-party management kind of comes in. Like the true value of third-party management is, hey, you're a real estate developer, you're not an operator. And what are you good at? I'm good at developing real estate. Am I really good at operating? Not so much. And obviously, I'm a third-party, management company here at Just Storage. So the conversations are very quick and it's like, do you want to expand or do you want to go ahead and do it on your own? And that's a very human thing to ask yourself. Like, am I willing to let my one self-storage facility go for somebody that sent me an email and maybe I'm interested? I think it really boils down to that. And I would say to your point about is it a necessity? If you have a REIT that's building in your 3 mile radius, yes, 100% it is because they could just totally, kill your rate and your occupancy. But if you're
Right.
not and you're in more of a tertiary, secondary market and you feel really good about operations and you still want to hold on to that baby, go ahead. But it's really up to the owner because at the end of the day, they're the ones that bought the facility, not me. So
I agree that especially if you're in a major market and you're competing with a number of REITs, and I get asked this question frequently, when it comes to just your processes and marketing and all of those things to be able to compete on the same scale, and marketing costs aren't getting any less expensive, but scale tends to help. It's by far in somebody's best interest. Again, if they're a developer, not a lot of experience in the industry, especially with the current conditions, that's where that experience of a third party, manager or management group is really going to benefit.
Thank you for that insight. So, we're coming up on the hour here. And as we wrap up, I have one final question for you both. Looking to the coming months, what headwinds or tailwinds do you anticipate impacting the self storage industry?
well, at least on my end, the Google Trends of self-storage kind of search, which is where I really start everything, revenue management, operations, whatever. It's still on a downward trend, but it's back to the mean of pre-COVID. So I think rental rates will still kind of decrease nationally. So that's kind of the tailwind, or excuse me, the headwinds that I see. But the tailwinds I see are being much more aggressive in tertiary and secondary markets because some of these new upstart, developers in self-storage are some of the most optimistic voices I see today. And to have the privilege to manage their properties with how much optimism they see compared to multifamily they did before, that is one thing I am genuinely looking forward to here in the next year or so.
One of the things that I would, um, you know, tell everybody is, especially as we're heading into the next year, is, and you're looking at rates and trends and things like that. Um, it just can't be overstated enough that data is really what the majority of quality operators and institutions are running on. And again, I'll use an example. I met a gentleman out in Vegas, and he was at a brand new. Speaking, Andrew, to what you said about being very super enthusiastic, and he was building a 90,000 square foot facility. It was his first foray into the business, and then we went and looked at. He was a local guy too. He was in the local market and was unaware of what was all coming in that pipeline. Was unaware of what was happening rate wise and trends in the market. And again, this is where each market's different. There are markets that are just performing very well. And then there are markets that are in decline. I think a lot is going to depend upon the interest rate and if the housing market gets rebooted and where that happens. I really think that's gonna be your positive side. So that's really the big thing I would pay attention to.
I cannot agree more with that. There's certainly a lot of optimism in self-storage, especially in Europe, where there's an increasing amount of institutional money going in because it's sort of this huge demand basket for self-storage. And to be able to really stay ahead, having that data is more crucial than ever. And I'm obviously biased here, but really nowadays, it's really having that actionable, data-driven insight. So data, that is going to be your friend.
I'm just learning about Europe and the UK myself. And one of the interesting things why they didn't feel data was important, it was not a demand issue, it was a supply issue. There wasn't
Ah,
enough supply anywhere. Something we haven't seen in the US and markets for a long time. So they're like, we build them and we fill them.
well, if you talk to any of your clients out in Europe, truck parking, which is, industrial outdoor storage, that's very common in the EU, but not common in the US. So now it's like we're flipping it back to the EU because it's like, well, self-storage, we throw a dart at the map and we got to build storage. Where here in the US, if you throw a dart at the map for iOS truck storage, it's the same thing. So next time, talk to them. But that's the way I feel here about that asset here, where it's very common in the EU. So that's too funny. I love that.
And I think there's a lesson there also, because if you think about it, across other industries, tech specifically in the 90s and early 2000s, there were large companies that had what they thought was this unbreakable grasp on the market, and they became very comfortable. So they didn't prepare for, in our example, an onslaught of entrants, and each one with a different value add to their product. So I think that having that data and looking at where the trends are going is paramount. It's almost like a hedge against what could happen in the future to your business, your bottom line. Because if there's an opportunity you saw there, everyone else is likely seeing it too.
StorTrack, you guys do phenomenal work in terms of data. So thank you.
Thank you for those kind words, Andrew. It's clear that self-storage is evolving rapidly with plenty of challenges and opportunities on the horizon. Andrew and Jim, thank you both for sharing your expertise and perspectives. And to everyone joining us today, thank you for being here. We hope you found today's session insightful. Please reach out with any follow-up questions, and we look forward to continuing the conversation in future webinars. Be well.